Let's talk market fundamentals with Pankaj Pandey, Head of Research with ICICI Direct. Pankaj, what do you make of this week's price action? Nifty has appreciated by a good solid 100 points from the recent low. Do you think the kind of price action what we've seen in last 2 days is some kind of an harbinger of what lies ahead?
Good morning, Nikunj. From my side, I see a significant discord between market performance and the earnings growth. So in that sense, last year you had 26% kind of market performance, whereas the earnings growth was in single digits. Now this year also, if you look at the Q3 EPS of Sensex, there's hardly any growth from the Q2 levels. And you had GDP growth rate at 4.6. So given that, I think there is a big anxiety towards what will happen on the growth front. And which is why I believe that since we are already trading at 16 times FY13 basis, so room for further expansion is quite limited. So according to me, the upsides in the market look capped. And in case the growth or the earnings growth does not pick up, probably you'll see some kind of a de-rating of the markets.
Pankaj, at the current juncture, how would you map the risk-reward ratio for our viewers?
So in terms of, like I said, to me the upsides look capped. What we have seen last year is that the multiples have expanded from about 12, 13 times to about 15, 16 times. So in case if the growth remains in single digits, so we were hoping that the growth would be in the range of 15, 16 odd %, but probably I think the way things are moving up, again we might see growth in single or low double digits. So in that sense, I think you could see possibly de-rating to 12 to 13 kind of a multiple. So that will sort of peg market values at 15 to 16,000 levels for Sensex.
Pankaj, hi, morning. What's the call on names like M&M? Because a whole host of news flow coming in. Of course, problems going on with their plant. They're also looking to sell a 4% stake in Mahindra Holidays and raise some money by way of that too.
I think M&M has been doing quite well on the passenger vehicle front, so including the UVs. So they have grown at about 20% on for the 11 months. I think compared to that, a lot of other players have been suffering. So in that sense, M&M has been doing well. The product portfolio is quite good. I think from that perspective, I think at about 12 times, we feel it's a buy with the target prices of about 918. I think in terms of Mahindra Holidays, it's a special or a niche kind of a story wherein if you look at, you had seen the number of registrations going up to about 140,000 last year. Though the volumes have been flat, so in that sense it might look expensive, but I think given the kind of niche story it is, probably at 22, 23 times with a debt-free company, I think one can still sort of look at, though we are not really expecting anything big from a shorter-term perspective.
Do you think the current liquidity setup is not all that supportive? You know, globally things are moving from strength to strength. But if I look at what Indian markets have done this year, we are underperforming most of the big developed markets, and liquidity setup is no longer supportive or strong.
Well, if you look at, we have seen big swings in the market. So CY11 we were at the bottom of the league, and CY12 we were at top of the league, and now again I think we are slightly underperformers compared to global peers. I think the world has been sort of postponing their problems, so it's not that any part you have seen the problems getting solved. So it is just that the problems are postponed and hoping that they will find a better solution for that. So in that sense, liquidity has been the factor which has been driving the markets, and probably can drive the markets higher, but my sense is that one also needs to look at the kind of earnings growth which stocks or the markets would deliver. So once you realize that, probably it becomes difficult to sort of believe that the market will continue moving higher and really not take a knock.
In general, would you say that RCF is a completely different kettle of fish? NMDC evaluations were attractive. For NTPC, the big picture was quite attractive, and for Oil India, there were there were hopes that oil sector reforms would kick in. For RCF, I'm afraid there are no clear triggers, at least in the near term.
Well, Nikunj, I think if you look at on the fertilizer space, I think a lot of policy action has been sort of expected, but nothing much or great has happened. So in that sense, probably the sector is yet to sort of realize its true potential, though I think from the build side, we've been importing big time. But my sense is that unless your macros are sort of cleared out, you would not really see any big decisive action, and which is why I think all these stocks do some kind of a random move up, but beyond that you will not see any sustainable trend in most of the counters.
Pankaj, do you think the Indian auto industry in the near term could go through a round of PE compression? Because currently the entire industry is getting twisted from all the ends. First, you've got a visible slowdown in the auto industry. B, the competition in the passenger car market and the two-wheeler market has intensified. C, now it is evident that most of the auto companies are experiencing labor problem, and labor or wage hike could be an issue going forward.
I think, Nikunj, from the valuation perspective, if you look at most of the stocks are in the 12 to 13 kind of a forward PE multiple range. So in that way, they are not expensive. Probably, I think, yes, the demand slowdown has been there, and you're right that there are certain pockets, especially like two-wheelers, wherein both the listed players are, all the three listed players are suffering, but whereas Honda is doing extremely well. I think in the passenger vehicle side, if you look at, I think Maruti has been doing okay, and probably going forward, if you have a scenario like wherein you get aggressive rate cuts from the RBI, and plus, I think another positive is that the raw material prices have sort of not really looking up, and there is a good chance that the raw material prices could correct. So in that sense, probably these stocks can do well, because I think compared to the rest of the market, if you look at all the this particular sector does not have any balance sheet concerns. The concerns is on the P&L side, I think, which can get revived if the overall scenario improves. So in that sense, I think for corrections in these stocks, one can look at most of the tier 1 names, except for two-wheeler, because we are expecting that both your Bajaj Auto and Bajaj Auto and Hero MotoCorp, probably the earnings CAGR would be in single digits, so which is why I think this particular space can be avoided. Besides that, I think one can look at on the four-wheeler space. In addition to that, I think if you look at going forward, we would expect that the earnings CAGR for the four-wheeler is likely to do well, and I think in case if the discretionary spend picks up, I think this sector can do well. So besides the defensive, this is another sector which one can look at on the declines.
Pankaj, given the way how most of the money managers are now throwing mid and small cap stocks out of their portfolio, do you think the premium for classic blue chips will only increase? And let me give you an example here. For this year, the only sector which has seen a PE expansion is IT.
Correct, Nikunj. I think what has happened is that there are 2 or 3 things which have happened. One, you have seen some bit of a currency depreciation. Another factor is that the commentary from most of the tier 1 IT companies has been positive, wherein they have been saying that the next year is going to be better than the last year. So in that sense, it's a very positive setup for the entire sector. And I think if you look at, you had better than expected results from Infi. So I think that led to the re-rating and some kind of a reallocation within defensives. But my sense is that one should, going forward over the next 1 year, the focus should be on defensives. It could be pharma, it could be IT, or it could be FMCG. So depending on where you see declines, I think one should look at these stocks. Like for example, Infi has still further scope for a PE expansion. It is available at 17 times compared to TCS, which is available about 21 times. So in that sense, one should be there in these defensives, and I think in a proportion which is suiting to them.
Okay, Pankaj, let you go on that note. Appreciate you taking the time out and joining us today.